Hey, everybody, we're going to talk about some cheap stocks today, and not in the sense that we normally do. Normally, when Tyler and I talk about cheap stocks, we're talking about things, with a low PE ratio, companies that trade for a low multiple of book value, things like that. Today, we are going to look at it from a dividend angle. Dividend stocks that have great businesses, relatively high yields, but are paying the highest yields that they have in some time. We're going to get into it in just a second. Before we do, take a minute and check out the link you see on your screen, fool.com/Frankel, for the top 10 stocks to buy right now from our sponsor, The Motley Fool. Great way to support this work we're doing. Again, that is fool.com/Frankel. Check it out. So, we're going to talk about a couple of stocks, and Tyler is going to talk about one in just a second. I'm going to talk about one that's one of my favorite companies that I've owned for a long time. This is Public Storage. Now, Public Storage is a relatively boring business. It owns a bunch of large scale storage facilities that people drop their stuff in and forget about for a year or so. Um, that is a great business. When I started investigating this company, I've been an investor in Public Storage for well over a decade now. Um, it is a really well run operation. The business fundamentals are fantastic in self storage. As long as a self storage operator keeps their debt reasonable, the break even point is something like 30% occupancy of their properties. Public storage is generally over 90%. Ticker symbol is PSA. They are the largest in their space. Um, they've more than doubled their dividend payout over the past 10 years. Not linearly. They're not like a dividend aristocrat or anything like that. They haven't increased their payout every year, but they've more than doubled their dividend. They haven't cut their dividend. They have a 4.6% yield, which I am going to put up a chart here in just a second. That is the highest they have paid out, other than a little blip around the middle of the COVID pandemic. That is the highest they've paid out in over a decade. So 4.6% yield, very impressive dividend payer. There's a couple things I really love about Public Storage, and I think Tyler and I have talked about this on the show before. Tyler brought this to my attention. Unlike most other self storage operators, Public Storage has not diluted shareholders a lot. They have generally not raised capital by issuing new shares. Very, very few over the long term. So that's number one, and that's great for long-term total returns. If you really want to be impressed, look at a long-term total return chart of Public Storage. It's one of the best long-term performers in the entire stock market, and the focus on responsible capital management, meaning not just using their cash flow, not diluting shareholders or taking on excessive debt, which is another thing I love about the company. They have a total of about $9 billion of debt, and that's compared to a $45 billion market cap. This is like if you bought a house and used a mortgage and you put 80% down and borrowed 20%. Very, very low debt. Um, the biggest name in the space. They're not the biggest name by the number of properties anymore, now that Life Storage and Extra Space Storage have merged, but they are the largest by revenue and by market value. Very high quality properties, very high quality company. Public Storage is a stock that I plan to own for a long time, and right now is a great entry point. I kind of wish I was buying it today, and I might add some more to my position at these high yields. Tyler, what are you looking at?
So I think I've mentioned this one before to you, but I'm looking at Rexford Industrial Realty. Ticker is REXR. This is an industrial real estate company. So, warehouses, distribution facilities, some light manufacturing, basically anything of that sort of ilk, not retail, not office or anything like that. So this has been always a particularly interesting company to me because it's a industrial real estate company that focuses solely on the Southern California market. So basically like Los Angeles County, Orange County, San Diego County, and a little bit into like San Bernardino Valley and Inland Empire. The reason it is so focused is because this is one of the largest industrial real estate markets in the world. It's bigger than Germany's. It would be like the fourth or fifth largest industrial real estate market by country in the world. Long Beach port, Los Angeles port. There's a whole ton of commerce kind of coming and going in the area, on top of just the typical things that you would expect to see in a large urban environment of the of the third largest uh, city in the country, and the kind of that megalopolis sort of area. This particular area, on top of being so large, also happens to have some of the lowest vacancy rates and some of the highest rent growth rates in the industry, because it's it's called a shrinking supply area, where basically like a lot of land is being rezoned for mixed use residential, things like that, and so a lot of that industrial zoned area is going away, and therefore the companies that are still left hanging on to industrial zoned real estate gets to charge pretty substantial premiums. Over the past several years, we've seen Rexford put in revenue growth, or sorry, uh, excuse me, net operating income growth numbers somewhere in the 50 to 60% range. I'm sorry, not the net operating income growth. I'm sorry, but the leasing spread numbers have been in the 50 to 60% range. Basically, meaning like when they go to, after a 5 to 10 year lease has expired and they sign that new lease, it tends to be 50 to 60% higher. According to Rexford, from 2021 to 2023, the average lease spread on their new released properties was 67%. These are absurd numbers. We don't typically see numbers like that in almost any real estate whatsoever. So uh, right now, it has a yield of about 4%. That's about the lowest, or sorry, the highest it's been in about a decade. And part of the reason is that some of that rent growth is starting to slow. Economic growth is slowing down a little bit, and you can't really expect 60% growth forever, right? And so the most recent quarter, we saw about 11 to 13%. Could be higher if you exclude, like, they did a special lease for one of its largest tenants. Excuse me. But all in all, there's still a lot of kind of what we'll call embedded growth in the business. Basically, and this is what I actually kind of really love about this business, is it can kind of like just like sit on its butt and do almost nothing, and uh, still generate quite a bit of actual growth. And this is its net operating income growth over the next 3 years of basically doing nothing. So over the next, between now and 2024 and 2027, between redevelopment, so like adding higher window bays for distribution facility, or truck bays for distribution facilities, things of that nature, we're looking at 94 million. Just marking up its existing leases an extra 80 million. We're talking about a 47% growth for just sitting on your butt. It doesn't have to do anything. And so with numbers like that, it gives you an idea of like how attractive this industry is, on top of the fact that the management itself has done a pretty splendid job of value creation over time. I would say one of the knocks has been is it uses a lot of issuing shares to do it, but because it has been, the growth and the kind of rates of return have been so good on what it has purchased, it's made it worth it. Over the past 10 years, it's grown its dividend annually by 17%. And so when you're looking at numbers like this, a yield of 4% doesn't exactly wow people. But if you kind of tie together the idea of getting 4% yield with kind of that sort of growth in your dividend, this looks like a pretty attractive business. And I don't see like huge fundamental changes coming to the industrial real estate sector in the next couple of years. So it looks pretty attractive to me.
Yeah, industrial real estate is just a kind of attractive play in general right now. Um, and in a lot of ways, is a real victim of rising rates. It's one of the kind of types of real estate that I think is going to be one of the biggest beneficiaries once rates start to fall a little bit. And it's something that I honestly need a little bit more exposure in my portfolio too. So thanks for giving me a nice gentle shove with Rexford right there. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.